Bitcoin's latest price plunge has sent fresh tremors across the global cryptocurrency markets, with the flagship digital asset slicing through key technical barriers and erasing tens of billions in value within hours, prompting urgent questions about whether the multi-year bull run that carried Bitcoin from the lows of 2022 all the way to a 2025 peak near $126,000 has finally exhausted itself or is merely pausing for breath before resuming its historic upward trajectory. Welcome to Crypto Hub, your trusted source for clear, fact-based cryptocurrency news and analysis. In today's update, we examine the deepening Bitcoin correction currently unfolding in real time, place the move in its proper historical and on-chain context, weigh the arguments on both sides of the bull run debate, and outline what serious observers should be watching in the days and weeks ahead. As of the most recent trading session on June 3rd, 2026, Bitcoin has traded as low as the mid-$66,000 zone after opening the month near $73,500, representing an accelerated sell-off that has taken the asset below the psychologically critical $70,000 level for the first time in recent weeks. The decline has been accompanied by more than $1.25 billion in leveraged liquidations across major derivatives platforms in a single 24-hour window, a cascade that typically amplifies downward momentum once stop-loss clusters are hit. Total cryptocurrency market capitalization has contracted sharply in sympathy, while Bitcoin dominance has risen modestly, a classic sign that capital is rotating out of higher-risk altcoins and into the relative safety of the largest asset, or simply exiting the sector altogether. The immediate triggers for this latest leg lower appear to combine several reinforcing pressures. Record outflows from spot Bitcoin exchange-traded funds reached their highest monthly total of the year in May, with estimates exceeding $2.3 billion, and in some reports approaching or surpassing $3 billion as institutional participants reduced exposure. These vehicles, which had been a primary engine of the 2024 to 2025 rally by giving traditional portfolios easy access to Bitcoin without the operational complexities of self-custody, have now become a visible channel for profit-taking and risk reduction. Additional headline pressure came from reports of large entity selling, including what some analysts described as the first notable Bitcoin disposal by strategy in nearly 4 years, alongside on-chain evidence that long-term holders and whales reduced positions by thousands of BTC in a short period. Geopolitical uncertainties and a broader risk-off tone in traditional markets have compounded the effect, as investors reassess exposure to assets still viewed by many institutions as volatile even after years of maturation. Placing the current move in historical perspective reveals striking parallels with prior cycle behavior. Bitcoin's 2025 peak near $126,000 followed the April 2024 halving in a timeline broadly consistent with previous post-halving bull markets, which have typically crested between 12 and 18 months after the supply shock. From that high, the asset has now retraced more than 47%, a drawdown that, while painful, remains shallower than the 77 to 85% declines recorded in the 2018 and 2022 bear markets. Analyst Benjamin Cowan has noted that similar seasonal weakness has appeared in June of previous midterm years within the 4-year cycle, often marking a local bottom before a relief rally into summer and a final capitulation later in the autumn. This pattern suggests the present weakness could be the market's way of resetting sentiment and flushing out leveraged speculation rather than the beginning of a multi-year bear phase. Yet the debate over whether the bull run has ended or is merely consolidating remains intense and data-dependent. On one side, cycle traditionalists argue that Bitcoin's 4-year rhythm, driven by the halving's supply reduction and subsequent demand response, remains intact despite the arrival of ETFs and greater institutional participation. They point out that the current correction is occurring within the expected window for post-peak digestion, and that historical precedent favors higher highs in the subsequent 12 to 24 months once capitulation completes. Long-term holders who accumulated below $30,000 continue to sit on substantial unrealized gains, providing a strong psychological floor, while network fundamentals such as hash rate have shown resilience rather than the sharp collapses that accompanied previous cycle ends. Some macro forecasters anticipate that anticipated shifts in monetary policy later in 2026, including potential further easing, could restore liquidity conditions favorable to risk assets and reignite institutional inflows. On the opposing side, a growing cohort of observers contends that structural changes in market architecture have altered the cycle's character. The ease with which institutions can now buy and sell Bitcoin through ETFs has accelerated both the speed of rallies and the velocity of corrections, potentially compressing the classic multi-year boom-bust timeline. Record ETF outflows in May signaled that even sophisticated allocators who entered during the ascent are now de-risking, a development some interpret as evidence that the marginal buyer who drove the 2025 peak has already stepped away. Veteran traders have floated targets as low as the mid-$50,000 range or even the low 40s if key supports near $65,000 to $68,000 fail, arguing that a deeper reset is required before sustainable new highs can form. They emphasize that 2026 may function as a transitional or reset year in which time-based capitulation replaces the rapid price discovery of prior bull phases, with new all-time highs deferred until 2027 or later. Technical and on-chain indicators currently paint a mixed but cautionary picture. Immediate support rests in the $65,000 to $68,000 band. A decisive daily close beneath this zone would likely trigger additional algorithmic and leverage selling towards $60,000 and the psychologically important $50,000 level. Resistance on any recovery attempt sits near the $73,000 to $75,000 area where price consolidated earlier in the month. On-chain, the proportion of long-term holder supply and profit remains elevated, yet the recent uptick in distribution from these cohorts suggests some are using strength or weakness to rebalance. Funding rates in perpetual futures have flipped negative during the sell-off, indicating that short interest is rising and that a short squeeze could fuel a sharp bounce if positive catalysts emerge. Meanwhile, the total crypto market's contraction from 2025 peaks has been broad-based, with many altcoins experiencing steeper percentage losses than Bitcoin, underscoring the flight-to-quality dynamic that often precedes cycle inflection points. Macroeconomic crosscurrents add another layer of complexity. While equity markets have shown relative strength in recent sessions, the decoupling between traditional risk assets and Bitcoin has widened, with some analysts attributing the gap to crypto-specific factors, such as ETF flow reversals, rather than a wholesale rejection of risk. Should central banks signal a more dovish stance in upcoming policy meetings, the resulting liquidity impulse could quickly reverse sentiment in digital assets. Conversely, any reacceleration in inflation data or geopolitical flare-ups could prolong the risk-off environment and extend the current corrective phase. Regulatory developments remain broadly constructive over the longer horizon, with clearer frameworks in major jurisdictions continuing to draw institutional capital. Yet near-term policy uncertainty can still weigh on sentiment. For market participants, the present environment underscores the importance of disciplined risk management over reactive trading. Long-term investors who believe in Bitcoin's secular adoption story may view the correction as an opportunity to accumulate gradually through dollar-cost averaging, focusing on the asset's shrinking supply schedule and growing utility as a store of value and settlement layer. Short-term traders, by contrast, face elevated volatility and should size positions conservatively while monitoring the key levels and flow data already discussed. Diversification across uncorrelated assets, maintenance of cash reserves for opportunistic buying, and avoidance of excessive leverage remain prudent regardless of one's directional bias. It is worth remembering that every prior Bitcoin cycle has included multiple 30 to 50% drawdowns even within the larger bull market. Those who endured them with conviction ultimately captured the majority of the upside. Looking ahead, several catalysts could determine whether this correction marks a generational bottom or the start of a more prolonged bear market. Continued ETF flow data will serve as a real-time referendum on institutional appetite. Any material improvement in macro liquidity conditions or resolution of geopolitical tensions could act as a spark. On-chain accumulation by addresses holding for more than a year would provide early evidence that smart money views current prices as attractive. Conversely, sustained outflows, further breakdown of technical supports, or a sharp rise in exchange reserves could signal additional downside. Seasonality also favors watching the June to July window closely, given historical tendencies for local lows during this period before potential summer rallies. Ultimately, the question of whether the crypto bull run is over or merely resetting hinges on time frame and perspective. For those measuring success in months, the current price action feels like the end of an era. For those measuring in multi-year cycles, the data still align with the digestion phase that has preceded every major leg higher in Bitcoin's history. The fundamentals that powered the advance from 2022 lows, institutional infrastructure, technological maturation, and supply dynamics have not disappeared. They have simply encountered a period of digestion and sentiment reset that markets of all kinds experience after parabolic advances. As we navigate these turbulent conditions, remaining grounded in verifiable data rather than fear or euphoria offers the clearest path forward. Bitcoin has survived far deeper drawdowns and far greater skepticism in the past, emerging each time with a stronger holder base and wider recognition. Whether the next chapter begins immediately or after one final washout will be determined by the interplay of flows, policy, and collective psychology in the weeks ahead. Thank you for watching this in-depth update from Crypto Hub. If you found this analysis valuable, please subscribe to the channel, enable notifications, and join the conversation in the comments with your own observations on the current market structure. We will continue monitoring developments closely and bring you updated analysis as new information emerges. Until next time, stay informed, manage risk responsibly, and we will see you soon right here on Crypto Hub.